New to investing or just simply starting out and want to improve your financial knowledge? Well, hopefully in the right place. Because the one thing we don't teach people is personal finance, the world of investing is considered simple to invest. My name is Dave, I work in financial services and I help people access their personal pensions. So the aim of the videos, my finance blog, is to teach people about personal finance so you can reach your goals sometime in the future. It's what allowed me to become a net millionaire in my early 50s. So let's get into this latest video. This is about my self-invested personal pension plan for the monthly review for January 2026. Now I do have a workplace pension, but I'm restricted 1 to contributions and 2 the funds I can hold, so I'll pick my own funds. So what are the aims? Well, we're looking for annual growth of 10% year on year, dividends during the year of £7,500 and a year-end portfolio value of £231,000. So how have we done the month? Well, we started at 198,563. We finished at 203,037. So we need month to date nearly £4,500 and annual growth of 2.43%. So a very nice start. Now, we make contributions first of the month, £250, what we call automated savings, and the government give us tax relief. So basically, a UK taxpayer, we got £62.50 as free money. And again, look at the chart. So we say put nearly £6,000 in tax year to date. Our platform providers charges fees of £20.88 in the month, and that's based upon a percentage of our portfolio. So some on fees, some on funds. Look at the following graphic, quick illustration. So as we said, 2.4% in the month, but look at the halfway through the chart, shall we say, we're beating the benchmark on a quarterly basis. We'll have good months, we'll have bad months, but just go to show you're not going to get every month right, but a nice start to the year. So where actually are we held? Well, at the moment, predominantly UK based. 77% in UK and Europe, 20% in USA and Americas, and a tiny 2.26% in Asia and emerging markets. Now, we received no dividends during the month, but we get some good results soon. That will soon come through. But across our shares, we've got a yield of 4.26%. But our main months, shall we say, will be April, May, and October. Let's look at what we hold in the portfolio. Well, nice and simply, we'll do our 2 funds. We've been simplifying, shall we say, and every month we put our contributions and our tax relief into a simple fund. Why? Because we were UK solely based. We've got a Fidelity World Index Fund, just over £31,000, 15.5% of our portfolio. Very low fees of 0.12%, holdings around about 1,400 shares, shall we say, but it's given us a nice return of about 10% year on year. Just switch off, no risk, it does what it said it in, but it's done subject for diversification. Our second fund is an LNG technology fund, £21,200, just over 10% of our slightly higher fees of 0.32%, and it owns around about 250 shares, predominantly US based, but again, a nice return year on year of about 10%, and both of them funds pay small dividends, which is reinvested in what we call accumulation units. Now remember, if you like the videos, smash the like button, subscribe to the channel. Now let's look at the shares we hold within the portfolio. The largest holding is Lloyds Banking Group. We own 38,500 shares, nearly £42,000, 21% of the portfolio. Very good result in the month, shall we say, even though the car scandal's in place, they put some redress in there, shall we say. But very cash rich, and the dividends increased by 15%. So a dividend, shall we say, in May of nearly £1,000. We own Aviva, 5,276 shares, £33,000, 6% of portfolio. Everyone needs insurance, very cash rich, has been a buying tree lately, and again a nice yield, but around about 7-8%. Good results will be due soon, shall we say, and again we'll pay nice dividends, £1,000 late in the year. We own HSBC, 1,322 shares, 70% of our portfolio, 8% of our portfolio. Now, away from the UK bank, shall we say, although it's listed UK, but it has struggled in China, but very good result recently, shall we say, overseas, and does pay a nice quarterly dividend. We own Barclays, 3,307 shares, £16,000, 8% of our portfolio. Hopefully results will be good, shall we say, middle of February. The yield around about 4 or 5%, but again, a very good, shall we say, trade statement within the banks recently. Or if the banks we own tracks the biomass of the pollen making, 1,357 shares, £12,500, 600 butter, is very cash rich, pays a nice dividend, but shall we say, what will happen shall be subsidies, somewhat shall we say of a not a love company within the sector because what it does. But everyone needs energy. We own L&G, the insurance company, 2,500 shares, £6,500, 3% of our product. Again, like a Aviva, very cash rich, mainly shall we say in pensions, shall we say life insurance. But again, a very nice yield, around about 8-9%. We own Greggs the Bakers, 302 shares, nearly £5,000, 2.4% of our product. Has struggled recently, shall we say, from trading statements, but it's very cash rich, makes nearly £1 billion, does pay a nice yield, and shall we say, it is improving, shall we say, but not on the high streets, mainly forecourts, service stations, shall we say, train stations. But it has been affected by the cost of living or national insurance wage increase, inflation. We own Sainsbury's, 1,413 shares, £4,500, 2.2% of it. Very good results at Christmas, very good trades and state dividend increase, but it's in a forever price war, shall we say, with other companies, especially Aldi. We own Shell and BP, 150 shares in Shell, £4,200, 2% of the portfolio, and 542 shares in BP, £2,500, 1% of the portfolio. Very cash rich, shall we say, in restructuring, shall we say, but they will pay a nice quarterly dividend moving forwards. We own JD Sports, 2,500 shares, £2,000, 1% of the portfolio. Has struggled, shall we say, recently, but some very good results, but didn't meet expectations. But it is making nearly £1 billion profit. Has invested rapidly in America in the last few months and Europe, but obviously as a growth company, does pay a small dividend. Other companies we own of note is Pennant, the water company. Has struggled lately, shall we say, but everyone needs water, just switch off, nice yield. We own AG Bar, the drinks producer, has been on a bounce lately, very cash rich, but what we see as a small growth company. We own AJ Bell, the platform provider, again, assets under management increased, clients increased, so we see is growing. Does pay a small dividend, but it will pay a dividend in the middle of February, but what we see as a growth company. And finally, we own Card Factory. Very cash rich, again, has struggled on the high street, just like Greggs, but does pay nice dividends, is expanding, shows it bought other companies in but it is affected by the high street. But it is trying to make an online presence. So just some but we got 15 shares, okay, 30 all in profit. No reason why there's only shares. We've not received dividends this month, but we've got some very good results due in the coming weeks, and we will make our expectations later in the year. Remember, you can build a sizable portfolio if you think long term. You invest in a tax-free pension wrapper, and you invest on a regular basis and reinvest all your dividends. So if I can do it, you can do it. Remember, like the videos, smack the like button, subscribe to the channel, and look at the blog to improve your financial knowledge.